Hey everyone, welcome back to Corporate Decoder. Are you ready to dive into another exciting adventure in the world of corporate shenanigans? Just kidding, but this report does have some surprises. Today we're looking at a filing from Evercore Inc. They're making some moves in the debt market, so let's break down what it all means. If you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Join us for more conversations. So Evercore is getting some new debt. On July 10, 2025, they made an agreement to issue some senior notes, which are essentially promises to pay back money to investors. They're doing this through something called a private placement, which means they're selling these notes to a select group of investors without registering them with the Securities and Exchange Commission, or SEC, as they would in a public offering. Think of it like a secret sale only for certain people. They're issuing two types of notes. First, there are the Series K notes, totaling $125 million with an interest rate of 5.117%. Then there are the Series L notes, another $125 million, but with a slightly higher interest rate of 5.47%. Both groups are due to be paid back in full sometime in the future. The Series K notes are due in 2030, and the Series L notes are due in 2030, and the Series L notes are due in 2032. So both of them are due to be paid back in just a few years. Evercore will pay interest on these notes twice a year, specifically on April 30 and October 30, and it all starts in October of 2025. The interest started adding up from July 24, 2025. Now, what's Evercore planning to do with all this money? Well, Evercore plans to use some of the money to pay back other debts that are coming due within the next year. They got those debts from previous agreements. The rest of the money that's going towards general corporate purposes, which could mean anything from investing in new projects to covering day-to-day expenses. The agreement Evercore made has some rules or promises, better known as covenants. These are essentially guardrails to ensure Evercore manages its finances responsibly. One covenant is a maximum consolidated leverage ratio. This is a debt ratio, meaning that they cannot borrow too much money relative to their assets. The ratio is set at 2.75 to 1.0, which is measured at the end of every 4 fiscal quarters. Another covenant is a minimum consolidated tangible net worth. This is like setting a floor for the company's worth, excluding things like goodwill, which is the value of the brand or reputation. Evercore must maintain a net worth of at least $325 million at the end of each fiscal quarter. The agreement also outlines what happens if Evercore fails to meet its obligations. These are called events of default. If any of these events occur and continue, the investors can demand immediate repayment of the notes, including any extra fees and interest. It's like a safety net for the investors in case things go south. The filing includes the fine print. There are exhibits that contain the exact wording of the note purchase agreement, as well as the forms for the Series K and Series L notes. If you're really into legal documents, that's where you'd find all the nitty-gritty details. Overall, Evercore is taking on new debt to manage existing obligations and fund its operations. The terms of the agreement include financial safeguards to protect the investors, but also give Evercore some leeway in how they run the business. Now, what does this all mean? Well, it seems Evercore is playing it safe in the financial arena. They're using new debt to cover old debt, like refinancing a mortgage. The interest rates on these new notes aren't too shabby, so they seem to have gotten a decent deal. One thing to consider is the debt load. Taking on more debt always adds risk. If Evercore hits a rough patch, those required interest payments could become a burden. Still, the covenants they've agreed to, like the leverage ratio and net worth minimum, should help keep them in check. As for the general corporate purposes, that's a bit of a black box. It could be exciting investments in growth, or it could be just keeping the lights on. Without more detail, it's hard to say if this is a bold move or just business as usual. In conclusion, Evercore's debt move seems like a calculated step. It's not a game changer, but it keeps them flexible. The real question is how wisely they'll use that borrowed money to drive future growth. Alright, that's our decoder for Evercore's latest filing. This might not be the flashiest corporate action, but understanding how companies manage their debt is key to seeing the bigger picture. What's your take on Evercore's financial strategy? Share your thoughts in the comments. If you found this analysis helpful, hit that like button and subscribe for more insights. Don't forget to check out our Discord channel for deeper discussions. Thanks for watching, and I'll see you in the next video.